Welcome to the Coin Bureau Weekly News Roundup. My name is Guy.
And my name is Jessica. Here are the top stories in crypto this week.
Pump and dump. BTC dumps, then almost breaks above 38k in response to spot Bitcoin ETF FOMO before crashing back to key levels. So, where is the crypto market headed next?
Ethereum versus Solana. ETH fails to pump on the news of another spot ETF filing, while Sol continues to rally with the help of Cathie Wood. When could ETH finally catch up?
SEC delays ETFs. Gary Gensler and the gang delay 2 more spot Bitcoin ETF applications, pushing the potential approval window to January 2024. What could happen between now and then?
OpenAI drama. CEO Sam Altman is fired as top employees resign, leading to concerns about the entire AI niche. How could this impact the crypto market?
And a closer look at last week's top-performing cryptos and where they could be headed next.
All this and more in just a moment.
Last week, the crypto market experienced a wild ride. BTC briefly fell below 35k on Tuesday. On Wednesday, it rallied past its recent highs and basically touched 38k. By Thursday, however, BTC had broken back down to 35k and continues to trade relatively sideways at the time of shooting. Now, the reasons for this volatile price action were simple: speculation and leverage. Newsflash, but the recent crypto rally has been driven mainly by the speculation around an imminent spot Bitcoin ETF approval. It was believed that last week was the final window for the SEC to make a decision until 2024. More about that later. Now, as expected, the fact that the SEC could decide on a spot Bitcoin ETF at any minute resulted in crypto traders taking on immense amounts of leverage. The practical effect of this was that it caused BTC's price to pump more aggressively than it has in recent memory. To put things into perspective, there were over $300 million of long liquidations on Tuesday, the most since August. Given that there still isn't much liquidity and market depth, this amount of sell pressure caused BTC's price to fall sharply, which caused additional long liquidations, and so on. Believe it or not, but it appears that the subsequent pump was caused by Bloomberg ETF analyst Eric Balchunas, specifically his tweets. As pointed out by many crypto traders on Twitter, or rather X, it appears that crypto trading bots are buying and selling BTC based on Eric's tweets about the spot Bitcoin ETF. The post which caused the most recent pump was the revelation that the SEC is in talks with exchanges about listing the spot Bitcoin ETFs. Now, as with all of Eric's recent posts, this is apparently part and parcel of an ETF application process, but of course it was interpreted as extremely bullish by the crypto bots. So this begs the question of where the crypto market is headed next. Well, it appears that only Eric has the answer, given that he's single-handedly moving the market these days. Jokes aside, the absence of any news about the spot Bitcoin ETF will likely result in choppy conditions, but again, more on that later. Now, as you can see, BTC continues to bounce above the Bollinger Band moving average on the daily chart. This has been a significant zone of price support, so much so that it has marked the bottom of the recent dumps. Notably, BTC has been above this moving average since mid-October. Zooming out to the weekly tells a fascinating story. On the one hand, BTC is clearly in a very strong uptrend. On the other hand, however, it faces a lot of resistance between 35 and 42k. I should note that the same was true around 30k, though BTC blew past that resistance level with little effort. The thing is that this resistance level was breached due to lots of bullish news about the spot Bitcoin ETF. Although it's still too soon to say for sure, it's possible that most of this news has already been priced in. This certainly seems to be the case when it comes to Ethereum's spot ETF applications. And by the way, If you're enjoying the video so far, be sure to smash that like button to give it a boost. Now, in case you missed the news, BlackRock recently filed for a spot Ethereum ETF, and last week Fidelity followed suit. For context, these are two of the largest asset managers in the world. News of these filings caused BTC to rally, and the rally has continued almost entirely because of related news. For ETH, however, the effect has been surprisingly muted. While ETH did rally by more than 10% in a day after BlackRock's ETF application, it didn't respond at all to Fidelity's filing. In fact, it even seems to have dipped a bit. This has left ETH holders wondering what the heck is going on. There are many possibilities. From a purely technical perspective, ETH has been looking a lot weaker than BTC on the daily, and it looks like it's about to fall below the Bollinger Band moving average. If you've been keeping up with the channel, you'll know that ETH has been looking weak against BTC too. The ETH BTC chart is looking bearish on the daily and especially on the weekly. The fact that last week's red candle was larger than the previous week's green candle foreshadows another bad week for ETH. This is called a bearish engulfing pattern, and you'll learn all about it in an upcoming video, so stay tuned for that. Now, from a more fundamental perspective, Ethereum's adoption has apparently been lagging behind Bitcoin's in recent weeks. This is because Bitcoin has flipped Ethereum by transaction fees for the first time in recent memory, thanks in large part to the hype around Ordinal's NFTs and related projects. And an Ethereum developer simultaneously revealed that the adoption of Ethereum's account abstraction has been negligible. For reference, account abstraction, aka EIP 4437, was introduced earlier this year, and it was expected to lead to UI optimizations that would increase Ethereum's adoption. Well, it appears that in practice, all that really matters is promotion by TradFi personalities. This is a reference to ARK Invest founder Cathie Wood, who reportedly caused Sol to rally with her recent comments. This would not be surprising given that she said, quote, Solana is faster and more cost-effective than Ethereum. The craziest part is that many TradFi investors seem to share Cathie's opinion on Sol. That's because Grayscale's Solana Trust is reportedly trading a whopping 9x premium relative to the Sol the fund holds. For those unfamiliar, it's mainly large TradFi investors who invest in Grayscale's crypto trusts. If CoinShares' data about TradFi investors is anything to go by, though, chances are that they're aping into Sol because they're feeling the FOMO, much like us retail investors. As the saying goes, it's often the narrative that follows price action. This is probably truer in crypto than any other market. Lo and behold, Sol's recent price has been more explosive than BTC's. Like BTC, Sol is overbought on almost every technical metric, but refuses to crash or correct. And come to think of it, Sol looks eerily similar to how ETH did during the 2019 bear market rally. ETH eventually corrected by almost 60%. Make no mistake, if you feel the FOMO, chances are you need to check yourself before you wreck yourself. If you need help with that, then you can check out our trading strategy tutorial in the description. And while you're at it, check out the Coin Bureau deals page for trading fee discounts of up to 60% and bonuses of up to $40,000 on the best crypto exchanges. It's for a limited time only and exclusively for Coin Bureau viewers. The link will be in the description. Now, speaking of ETFs, you'll recall that the first window for the SEC to approve the pending spot Bitcoin ETF applications reportedly closed last Friday. That's because the SEC delayed the applications by Franklin Templeton and Global X. FYI, the SEC apparently had until tomorrow to decide on Global X. As I mentioned earlier, the next window for the SEC to approve these spot Bitcoin ETF applications is January 2024, starting from the very first day of the month. As you can hopefully see, the SEC will be making decisions about almost every spot Bitcoin ETF filing during the first 2 weeks of January. Bloomberg ETF analysts Eric Balchunas and James Seyfarth both believe there is a 90% chance that the SEC will approve one of these spot Bitcoin ETF applications. Now, it's believed that the SEC will approve all the applications at once so that it's not accused of picking favourites after the fact. BlackRock. In all seriousness, it's also believed to be a given that BTC will pump when all of these spot Bitcoin ETFs are approved. As we saw with the recent approval of the Ethereum Futures ETF, however, this may not be a given. After all, ETF approvals only guarantee availability, not investment. Even so, there is a very high chance that these Bitcoin ETFs will see inflows. After all, the whole reason why all those asset managers applied to begin with was because there was demand from their clients. I'll reiterate that these asset managers are some of the largest in the world, trillions under management. If even just a small fraction of that money managed to find its way into BTC, it would definitely pump. Then, large entities within the crypto industry would likely take profits on their BTC and rotate into ETH and altcoins, causing an alt season that's even hotter than the one we've seen so far. There are, however, just two caveats. The first is that this catalyst seems to be a bit premature. For those unfamiliar, the listing of Bitcoin futures on the CME marked the top for BTC back in 2017. The listing of the Bitcoin Futures ETF, based on the CME, effectively marked the top for BTC in 2021 as well. Now, obviously, history doesn't repeat, but it does rhyme, and in this case, we seem to be dealing with an entirely different language. It's strange that something which is supposed to be a top signal is expected to occur towards the tail end of a bear market, but some would say that crypto is seldom logical. Anyway, the second caveat is a bit more significant, and that's the fact that the reasons why the SEC rejected previous spot Bitcoin ETF applications have yet to be addressed. This was underscored by BitGo CEO Mike Belshie late last week, who noted that the SEC is very specific when it comes to BTC custody. From our perspective, the bigger issue is that most of BTC's trading volume is still taking place on crypto exchanges that the SEC doesn't have much oversight over, and against a stablecoin that is relatively unregulated. This is an issue that the SEC has specified in its previous spot Bitcoin ETF rejections. As such, if Eric and James's prediction that a spot Bitcoin ETF will be approved in January is correct, then it could mean that we're about to see a clampdown on the offshore crypto industry to make sure it happens. Remember that the regulatory scrutiny of crypto has continued to increase. On that note, another industry that has seen lots of regulatory scrutiny lately is AI. As some of you may have heard, US President Joe Biden recently signed an executive order about AI. It was analogous to the executive order about crypto that Biden signed last year, just before the crypto market completely collapsed. To refresh your memory, Terra imploded in May last year, which caused a bunch of different crypto hedge funds and crypto platforms to go under. This eventually led to the collapse of FTX, although some would argue that there were much deeper issues there. More about that in the description. Regardless, the consequence of the subsequent crypto crash was that regulators had multiple excuses to crack down on the crypto industry. Now, it's possible that what's been going on at OpenAI could be the first of many excuses that regulators around the world will use to crack down on AI. To bring you up to speed, OpenAI CEO Sam Altman was suddenly fired by the company's board of directors last Friday. OpenAI's president, Greg Brockman, subsequently stepped down in protest. Multiple senior employees also walked off the job over the weekend, and investors are reportedly panicking. In a statement, OpenAI essentially said that Sam was fired for lying to the board. The obvious question is about what? Chances are we'll find out later this week. Then again, OpenAI's board of directors is reportedly considering reinstating Sam as CEO due to pressure from investors. If you watched our video about OpenAI, you'll know that 49% of the company is owned by Microsoft, another 49% is held by other investors, and the non-profit behind OpenAI holds the remaining 2%. This means that Microsoft has lots of influence over OpenAI and its technologies, like ChatGPT. Given this fact, it stands to reason that Microsoft does not want to lose control of OpenAI or see the company fall apart because of internal issues. Case in point, Microsoft immediately announced that it would continue to support OpenAI shortly after it was revealed that Sam had been fired. Here, though, is where things get interesting. Microsoft's announcement about OpenAI made no mention of Sam being fired. More importantly, Microsoft told its employees to stop using ChatGPT earlier this month, citing security and data concerns. Discord also announced that it would ditch its ChatGPT bot on Friday. Now, taken together, these facts suggest that Sam likely lied about how OpenAI was using data in its operations. This would make sense given that an AI's power depends on how much data it's trained on. This creates a huge incentive to feed it as much data as possible, never mind the AI arms race. Whatever the case, it's clear that the OpenAI drama could do damage to the stock market. That's because Microsoft's stock fell by 2% when investors found out that Sam had been fired. Given the events that have transpired over the weekend, it's safe to assume that Microsoft will trade lower today. This, though, ultimately depends on whether OpenAI manages to restore the status quo before the markets open. If they do, then it will probably result in a big rally. But if they don't, it could result in a big crash. This is simply because the AI narrative is what's been driving the stock market for most of the year. OpenAI has been at the center of the AI narrative and industry. Any issues with the company could therefore create problems for the entire niche. Now, insofar as crypto is still correlated to tech stocks, whatever happens to OpenAI over the next week could move prices, particularly for AI-related cryptos. So, watch out. Anyway, with all that said, it's about time we looked at last week's top-performing cryptos. So, take it away, Jessica.
Thanks, Guy. Well, last week's top-performing cryptos were Celestia, Casper, Render Network, Avalanche, and Arweave. Starting with Celestia, its TIA coin appears to have pumped because of the project's participation in the ETH Istanbul hackathon, which took place over the weekend. As you've probably noticed, TIA has been rallying like crazy ever since its mainnet launch on the 31st of October. That's because it was simultaneously listed on the biggest crypto exchanges, including Binance. Given that TIA is still in price discovery mode, it's hard to say where it's headed next. Next up, we have Casper, whose Cas coin appears to have pumped because Binance listed a perpetual futures contract for the crypto. This presumably foreshadows a spot listing, hence all of the excitement. Like TIA, Cas is in price discovery mode, which makes its price impossible to predict. Given that Cas already has a market cap of over $3 billion though, it's probably not going to go much higher from here, given the absence of widespread retail FOMO. It's easy to forget we're the only ones paying attention. Now regarding Render Network, its RNDR token appears to have pumped because the project has introduced GPU onboarding for its network. In plain English, it will make it possible for developers to build AI models on the network. It's still a little bit complicated, I know. As you can see, RNDR has rallied more than 10x over the last year. It's currently pushing up against a significant zone of resistance, and it's questionable whether it will be able to make it through. That's because the recent rally has been extremely parabolic. It is hard to see how it could go higher without correcting. When it comes to Avalanche, its AVAX coin appears to have pumped on the news that JP Morgan is testing tokenized assets on its blockchain. Now, I should note that the megabank also tapped Axelar for the trial. That's some alpha for you there. Like RNDR, AVAX has rallied a lot in the recent weeks, but is facing a wall of resistance, specifically throughout the $20 range. It's going to take a very bullish catalyst for AVAX to break through this zone. With some luck, it will get one. Finally, we have Arweave, whose AR coin appears to have rallied due to a surge in transactions on its so-called Permaweave, a decentralized storage solution that's designed to store data permanently. Like AVAX and RNDR, AR's rally could be stopped by the enormous price resistance above the $9 level. On-chain analytics also suggests the recent surge in transactions was short-lived. Both indicators point to a correction, an opportunity for accumulation, some might say. Note that if you do want to find out why crypto projects are pumping in real time and also where you can trade them, you can check out the Coin Bureau Telegram channel. The link will be down in the description.
And that's all for today's Coin Bureau Weekly Crypto Review.
If you enjoyed it, then you know what to do. Hit that like button, subscribe button, and bell icon too.
Don't forget to check out our deals page, where we have massive discounts and airdrop bonuses of up to $40,000 on some of the best exchanges, only for the viewers of this channel.
Also, if you want to pick up some snazzy crypto merch, the Coin Bureau merch store has it all.
You can find the link to that resource and many others in the description below.
Thank you so much for watching. We'll see you all in next week's episode.